Bank denials often feel personal, but the decision is purely mathematical. The financial system runs on risk models, not character judgments. To gain access to high-limit capital, you have to understand the specific five-factor algorithm underwriters use to calculate your risk. This strategy requires a strict 60 to 90-day preparation window. This time is necessary to allow your data to settle and report correctly across all bureaus. The process begins with two prerequisites. Pull your reports from Equifax, Experian, and TransUnion, then immediately freeze all new credit applications. Treating your credit as a technical risk model provides a roadmap for the next 3 months. Every action from this point forward is designed to adjust a specific variable within the bank's underwriting formula. Payment history functions as a behavioral dataset. Underwriters analyze these patterns to determine if a borrower will maintain obligations when liquidity is low. You must stop the bleeding on your report. Audit your files for late payments or collection marks, and dispute inaccuracies using certified mail. Avoid using debt discharge strategies on active accounts during this period. A single planned late payment triggers a massive score penalty and flags your profile as high risk in the system. Credit utilization is the second factor. High balances signal financial stress. Drop revolving usage below 10%, but wait for the statement cycle to close to officially report. Beware of spiking. Maxing out cards right before applying signals volatility and triggers a denial. Managing your history and utilization turns a stressed credit profile into a disciplined dataset that meets the first two requirements of the underwriting formula. The third factor is your debt-to-income ratio. Underwriters use this as the primary metric for financial fragility. This calculation subtracts your monthly debt obligations from your verifiable take-home income. When nearly equal, the borrower is fragile. You stabilize this ratio by aggressively paying down installment loans or proving a higher income. Even with a perfect credit score, an unbalanced debt-to-income ratio will trigger an automatic denial for high-limit funding. A low ratio demonstrates that you have the capacity to absorb financial shocks without defaulting on new credit lines. Stability markers are the fourth risk factor. Underwriters penalize profiles with chaotic personal data, such as multiple addresses or frequent job changes. Contact the credit bureaus to consolidate your file. You want your report to reflect one current address and one stable employer to maximize predictability. The fifth factor is asset and relationship backing. Banks are risk-averse. They prefer to extend capital to entities vetted through internal data. Open checking and savings accounts at the specific institution where you intend to apply. Establish a pattern of consistent weekly deposits. This creates a favorable internal record that the bank's own software uses to calculate your approval limits. Presenting clean data alongside an established banking history lowers your perceived risk from an unknown variable to a trusted asset. After 90 days, your profile is optimized, your history is clean, your utilization is sub 10%, and your banking relationships are established. This meticulous preparation ensures that your new profile completely meets the strict, specific risk thresholds set by the bank's underwriting model. You are now ready for funding season. This involves strategically stacking your applications across different bureaus in a tight window to maximize your total capital access. The system rewards borrowers who provide clear, stable data. When the profile structure is correct, high-limit approval becomes a predictable output of the underwriting process.